regulators are accusing Robinhood of what they call aggressive tactics in marketing inexperienced investors, using gamification to manipulate those customers, and failure to prevent outages on that trading platform this year.
You may have heard that Robinhood, the brokerage, not the man, recently went public and had their IPO just a couple of weeks ago using ticker symbol HOOD. Hood. I'm going to talk about that IPO a little bit. I'm going to do a quick Robinhood stock analysis, and I'm going to tell you why I'm not buying shares for now. Robinhood is a relatively new online brokerage that busts into the scene and quickly gained market share with their commission-free trading and by gamifying investing. Many brand new investors and traders have opted to use and try the Robinhood platform. Now, Robinhood has had their issues, mainly with liquidity and being able to manage the sometimes extremely large volumes of trading that their users do, especially when they focus on specific stocks like we've seen with meme stocks. There's also been concerns raised about the risks of Robinhood gamifying investing and encouraging its users to trade more and more, allowing brand new investors and traders to invest and trade with too much margin and or invest and trade complex securities like options without proper education. Despite this, Robinhood has decided to use their momentum and go public and recently had their IPO, coming into the markets around July 29th with a price share of around $40 per share and a market cap of about $35 billion. At first, Robinhood's IPO was kind of lackluster, trading down or sideways for the first few days, but recently this past week it spiked up 75%, reaching $70 per share, and you can thank Cathie Wood's ARK Invest for that. Now, I love Cathie and the ARK funds, and I agree with her on many picks like Coinbase, Tesla, Shopify, and others. But I am not rushing into buying Robinhood shares, and I'll tell you why. First, I'm not a Robinhood user, and I usually like to invest in companies that I know well, preferably companies that I'm a customer of, Google, Apple, Netflix, just to name a few. And I don't plan on using a Robinhood account very much either, mainly because of all the bad experiences that I've heard of other users having, as I mentioned earlier. So already I'm not really interested. But even with that aside, the fundamentals aren't really there for me either. In my opinion, I think the share price is a little bit aggressively and overpriced right now compared to other options out there in the market. Because Robinhood right now is not profitable, they don't have any earnings, so they don't have any price to earnings ratio or PE ratio. So the best way, or one of the best ways that we can evaluate its valuation, is by looking at its price to sales. Robinhood's current price to sales is about 43. So its current valuation is about 43 times its revenue in the last 12 months. As a comparison, Coinbase has a price to sales of about 22 and is extremely profitable. Tesla has a price to sales of about 17 and is profitable. But profitability aside, why is Robinhood being priced so aggressively and as if they're gonna grow more than Coinbase and Tesla? That doesn't make sense to me. For example, Coinbase is on pace to triple or quadruple revenue year over year in 2021. Robinhood is on pace to grow about 100% year over year. So we do have to compare the growth rates too. In my opinion, Robinhood isn't even a leader in its space. So how do they expect to stay competitive in this market? They already have a mixed reputation. There are many online brokerages out there and many more coming onto the scene, as well as others with commission-free trading. So although I do see the online investing and trading space growing in the years to come, I don't necessarily see Robinhood being or staying a leader in the space compared to something like Coinbase in the crypto exchange space or other companies in other sectors. Plus, I usually avoid investing in IPOs too early because oftentimes they come into the public market too aggressively priced, often falling in price before finding its footing, which we've seen with many IPOs. These shares are still too new in the market for me. I think it's still a little bit too aggressively priced. The valuation in terms of price to sales to growth is just a little bit more aggressively priced right now compared to other options out there. So I am not buying shares for now. Even if I did want to buy shares, because I can always change my mind, at least wait like 20 days to get a 20-day moving average line in there so you can at least see a trend and maybe buy the dips on the way up. But what do you think? Are you invested or planning to invest in Robinhood shares? Let me know in the comments. I hope you enjoyed this video. If you did, please hit that like button to like this video. It really helps the video and the channel. Make sure you're subscribed to the channel too for more content just like this. I put out videos every week, mainly on personal finance, investing in stocks, funds, real estate, crypto, and more. Alright, that's it from me for this video. So I will wish you a good day, a good night, and I'll see you in my next video. Alright, peace.